Is Canada heading toward economic collapse? It's a question that sounds absurd on the surface. Canada, a G7 nation with strong democratic institutions, comparing itself to Venezuela, a country that experienced one of the worst economic disasters in modern peacetime history. Yet, some commentators are making exactly this comparison. Canada's rising deficits, increasing debt levels, and economic challenges have prompted warnings from certain quarters that we're on a dangerous trajectory. But is there any truth to this claim? Or is it pure fear-mongering designed to generate clicks and views? Today, we're going to examine the facts, compare the numbers, analyze the fundamentals, and give you a clear, evidence-based answer. Because when it comes to your economic future, you deserve more than hyperbole. You deserve the truth. Let's start by honestly assessing where Canada stands economically as we enter 2026. The picture is mixed, with both challenges and strengths. On the challenging side, Canada's federal government is running significant deficits. Budget 2025 projects a deficit of $78.3 billion for the 2025 to 26 fiscal year. That represents 2.5% of GDP, the highest peacetime deficit since 1995, outside of the 2008 financial crisis and the COVID pandemic. The federal debt-to-GDP ratio sits at approximately 42% and is projected to remain above 43% through 2029 to 2030. That's substantially higher than the pre-pandemic level of 31% in 2019 to 2020. Public debt charges are rising too, expected to reach $55.6 billion this fiscal year, or 1.8% of GDP, climbing to over $76 billion by 2029 to 2030. Economic growth has been disappointing. Private sector forecasters expect real GDP growth of just 1.1% in 2025 and 1.2% in 2026. That's well below the growth rates projected just a year ago. Unemployment has risen to 6.8% as of December 2025, up from lower levels earlier in the year. The jobs market has added positions, but many are part-time and hiring remains subdued. Canada is also facing a restaurant crisis, with an estimated 4,000 net closures expected in 2026. Population growth has slowed dramatically to just 0.3% quarter over quarter in Q3 2025, the slowest on record outside the pandemic, as immigration policies shift. Trade uncertainty looms large. The USMCA trade agreement is up for renegotiation in summer 2026. U.S. tariff threats, though largely avoided so far, due to trade agreement protections, create business uncertainty that has dampened investment. Pre-construction housing starts have collapsed in major markets like Toronto and Vancouver. That's the challenge side. But context matters enormously here. Now let's examine what actually happened in Venezuela, because understanding this contrast is essential. Venezuela's economic collapse wasn't gradual. It was one of the most severe peacetime economic disasters in modern history. Between 2013 and 2020, Venezuela's per capita GDP contracted 73%. Let me repeat that. The economy shrank by nearly 3/4. This was the 15th largest economic crisis in modern history and the largest outside of war, revolution, or state collapse. In dollar terms, Venezuela's economy contracted from $196 billion in 2013 to an estimated $80 billion by 2018, making it smaller than Guatemala's or Ethiopia's economies despite having the world's largest proven oil reserves. The inflation story is even more staggering. Venezuela entered hyperinflation in November 2016. By 2018, annual inflation reached 130,000% according to the IMF. Some estimates for 2019 put inflation at 10 million percent. The Venezuelan currency, the bolivar, became essentially worthless. Citizens needed wheelbarrows of cash to buy basic goods, eventually abandoning the local currency entirely for US dollars. Oil production, the lifeblood of Venezuela's economy, collapsed from around 3 million barrels per day at the turn of the century to barely 1 million barrels per day by the height of the crisis. The state oil company, PDVSA, was gutted as technical experts were replaced with political loyalists. Decades of underinvestment and mismanagement destroyed productive capacity. The human cost was catastrophic. Food shortages became routine. The healthcare system collapsed. Preventable diseases resurged. Maternal and infant mortality spiked. Approximately 7.7 million Venezuelans, roughly 25% of the total population, fled the country seeking food, medicine, and safety. This became one of the largest refugee crises in the world. What caused this disaster? 3 primary factors. First, complete economic mismanagement, including price controls, profit controls, currency controls, and uncompensated property expropriations that destroyed private enterprise. Second, massive money printing by the central bank to finance government spending, directly causing hyperinflation. Third, the capture and hollowing out of democratic institutions, meaning there were no checks or balances to stop destructive policies. Now that we understand both situations, let's examine the fundamental differences that make the Canada-Venezuela comparison deeply flawed. First, institutional strength. Canada has robust, independent democratic institutions. The judiciary operates independently. The Bank of Canada maintains monetary policy independence from the federal government. Parliament provides checks and balances on executive power. Elections are free, fair, and produce genuine changes in government. Venezuela, by contrast, saw Presidents Chavez and Maduro systematically dismantle institutional safeguards, capturing the electoral authority, judiciary, military, and media to consolidate authoritarian control. Second, monetary policy. The Bank of Canada targets inflation around 2% and has successfully maintained that target even through recent economic challenges. Current inflation is within the target range. Venezuela's central bank was essentially turned into a money printing operation to fund government spending, directly causing hyperinflation that destroyed the currency. Canada has never and would never pursue such policies. Third, economic diversification. Canada has a highly diversified economy across manufacturing, services, natural resources, technology, finance, and agriculture. Resource exports are important, but represent perhaps 15 to 20% of GDP, not 98%, as in Venezuela at its peak oil dependency. Canada exports to multiple markets globally. Venezuela became almost entirely dependent on oil exports, particularly to a handful of buyers, creating catastrophic vulnerability when prices fell. Fourth, fiscal sustainability. Canada's debt-to-GDP ratio of 42%, while higher than ideal, remains moderate by international standards, and far below levels that would trigger serious sustainability concerns. Most G7 nations have higher debt ratios. Canada maintains its A credit rating. Venezuela ran massive fiscal deficits, financed entirely by money printing, with no access to international capital markets and no fiscal discipline whatsoever. Fifth, rule of law and property rights. Canada has strong legal protections for property rights, contract enforcement, and business operations. Investors can operate with confidence that rules won't arbitrarily change. Venezuela engaged in widespread uncompensated expropriations of private property, particularly in the oil sector and agriculture, destroying investor confidence and productive capacity. Sixth, trade relationships. Canada benefits from USMCA protections that have shielded approximately 90% of exports to the United States from tariff threats. The effective tariff rate on Canadian goods remains among the lowest of any major U.S. trade partner. Venezuela faced international sanctions and isolation that cut it off from markets and investment. This doesn't mean Canada faces no economic challenges. Let's be clear about the real issues that do require attention. Canada's productivity growth has been abysmal, averaging just 0.2% annually in recent years. Had historical productivity trends continued, Canada's economy would be approximately 18% larger today. This productivity challenge costs hundreds of billions in lost economic output and lower living standards. Business investment has been weak for over a decade, partly due to regulatory uncertainty and partly due to global trade tensions. This underinvestment contributes directly to the productivity problem. Housing affordability has reached crisis levels in major urban centers. Despite policy efforts to boost supply, pre-construction starts have collapsed in Toronto and Vancouver, suggesting the housing crunch will persist and possibly worsen. Provincial debt levels, particularly in provinces like Ontario, are concerning. While federal debt is manageable, combined federal and provincial debt brings Canada's overall government debt-to-GDP ratio to between 69 and 76%, depending on the measurement approach. That's getting into territory that requires careful fiscal management. The demographic challenge is real. Canada faces peak population aging as the largest baby boomer cohorts reach 65. This will strain healthcare systems and pension programs, primarily at the provincial level. Without productivity improvements, aging demographics will constrain economic growth. Regional economic fragmentation is increasing. Ontario and Quebec face challenges from potential U.S. tariffs on manufacturing. Resource-rich provinces like Alberta and Saskatchewan have different exposure and challenges. British Columbia faces its own housing and cost of living pressures. A one-size-fits-all federal policy increasingly fails to address these diverging regional realities. These are serious challenges that require serious policy responses. They justify vigorous debate about fiscal policy, monetary policy, immigration levels, productivity initiatives, and structural reforms. But they do not remotely suggest Venezuela-style collapse is on the horizon. The Canada-Venezuela comparison fails for one simple reason. The mechanisms that destroyed Venezuela's economy do not exist in Canada, and cannot exist given Canada is institutional framework. Venezuela's collapse required the simultaneous failure of multiple systems. Democratic institutions had to be captured and neutralized. The central bank had to abandon any pretense of monetary discipline. Property rights had to be systematically violated. Economic policy had to embrace price controls, currency controls, and state ownership that destroyed productive capacity. And political leadership had to persist with these destructive policies despite mounting evidence of disaster. Canada's system has multiple redundancies, preventing any single administration from pursuing such policies. The Bank of Canada cannot be ordered to print money to finance government spending. The courts would strike down widespread property expropriations. Parliament would resist extreme economic policies. And most importantly, voters would remove any government attempting Venezuela-style economic management long before serious damage occurred. The comparison also ignores Canada's economic resilience demonstrated throughout 2025. Despite trade uncertainty, consumer spending remained solid. Despite slower population growth, the job market added 180,000 positions in the final 3 months of 2025. Despite tariff threats, 90% of exports remained protected by USMCA. The IMF projects. Canada will have the second fastest growth in the G7 in 2026 after the United States. Is Canada's economic performance optimal? No. Are there legitimate policy debates about debt levels, productivity, housing, and fiscal management? Absolutely. But is Canada on a path toward Venezuela-style economic collapse? The evidence says no, emphatically. Here's the bottom line. Canada faces real economic challenges that deserve serious attention and vigorous policy debate. Productivity growth must improve, housing supply must increase, fiscal discipline must be maintained, business investment must recover. These issues matter enormously for Canadian living standards and economic prosperity. But comparing Canada to Venezuela is not serious economic analysis. It's rhetoric designed to generate fear rather than understanding. Canada has strong institutions, diversified economy, monetary policy credibility, rule of law, and democratic accountability that make Venezuela-style collapse impossible, absent a complete breakdown of the Canadian political and economic system. The comparison serves one purpose, to provoke strong reactions and drive engagement. But when you examine the actual data, the actual policies, and the actual institutional frameworks, the comparison collapses under scrutiny. Canada is not Venezuela. Canada will not become Venezuela. The economic fundamentals are too different, the institutions too strong, and the policy choices too constrained by democratic accountability. Focus on the real challenges. Demand better productivity policies. Push for housing reform. Advocate for fiscal responsibility. But don't let fear-based comparisons distract from serious economic analysis. Thank you for watching. If you found this analysis valuable, please like, subscribe, and share. Leave your thoughts in the comments, and I'll see you in the next video.